Petty cash. So as it says in the ACCT textbook, it is the amount of cash on hand within a business which is for small expenditures. As an example, let's say we want to start a petty cash within our business and we want it to be $15. However, a petty cash fund can contain as much cash a business wants. To form the petty cash, journal entries must be written, but it is a very simple entry which is the same every time. Normal entry format with the date, account names, and the debit and credit columns. We're forming our petty cash on the 1st of April and we debit petty cash because it's an asset, and credit cash as we're reducing an asset whose normal balance is a debit. So the petty cash and cash journal entries must have the same amount of money being debited and credited. Recording the expenses for petty cash only happens once the petty cash needs to be replenished, so all of the journal entries are made on the same date, similar to adjusting entries. Alright, let's say during the month of April, out of the $15, we spend $5 on lunch, $3 on stationery, and $1 on miscellaneous expenses. So in total we have spent $9. Let's put this in our journal. As such, we record the expenses in the debit column and list each of their amounts, and credit the amount of cash that needs to be put back into petty cash in order for it to be back at the original amount of $15 again. We have $9 worth of receipts and the amount of cash missing from petty cash is $9. A very simple petty cash example. However, let's say we spend another $2 on transportation expenses. The extra $2 brings up the expenses to $11. With the journal entries, here you can see the amount of expenses does not equal the amount of cash needed to bring the petty cash back to $15. Our expenses were $11, but the amount missing from petty cash is only $10. This is where the cash over and short entry comes in. Petty cash over and short is used to ensure the petty cash balance is always brought back to the original balance. A simple way to remember this is to put the over and short entry on the side that is smaller than the other side. What this means is that if the cash is less than expenses, put the cash over and short entry with the cash, and if expenses are smaller than the cash amount, put the cash over and short entry with the expenses. So going back to our example, we can see we have $11 of expenses and a $10 cash entry. Using our hint, we can see that cash is less than our expenses, so we have to put the cash over and short entry with the cash in order for it to equal the expenses. It's just a $1 difference, and now they are both equal to 11. But what if we didn't have the travel expenses and the amount needed to fix the petty cash back to its original balance was $11? There is only $9 worth of expenses and $11 missing. The expenses are less than cash, so in this case we must debit the cash over and short entry. The difference between the expenses and the cash is $2, so we simply debit cash over and short for an amount of $2, and they both equal $11.